It survived the San Francisco earthquake. It survived the Great Depression. It survived stagecoach robberies and world wars. But in 2016, the bank that built the American West was nearly destroyed, not by a bandit or a financial crash, but by its own greed. For 160 years, the stagecoach was a symbol of unwavering trust. Then, practically overnight, it became the symbol of one of the biggest corporate frauds in history. We're talking about a company that created millions of fake accounts, stole from its own customers, and was punished with a death penalty from the Federal Reserve that froze its growth for 7 years. How did an institution obsessed with security and reputation end up orchestrating a criminal enterprise from the inside? To understand the fall, you have to understand the height from which they fell. In the 1850s, America was a chaotic, dangerous place. If you wanted to send money from New York to the California gold rush, you were risking bandits, lost trails, and weeks of delay. Henry Wells and William Fargo saw this chaos and built a machine of pure reliability. They didn't just ship gold. They hunted down anyone who dared to touch it. When bandits robbed their stagecoaches, Wells Fargo didn't just file an insurance claim, they hired poses, tracked the thieves through the Sierra Hills, and recovered the gold. This brutal enforcement created a legend. You do not mess with Wells Fargo, and Wells Fargo does not lose your money. During the panic of 1855, when other banks shuttered and vanished, Wells Fargo stood firm, with agents facing down angry mobs and honoring every single draft. For over a century, that was the brand. Safety, prudence, the white eagle that watched over your wealth. But by the late 1990s, the Wild West was gone, and banking had become a boring, low-margin utility. The industry was consolidating, and to survive, you had to get big. In 1998, Wells Fargo merged with Norwest Corporation. On paper, it was a merger of equals. In reality, it was a cultural takeover. Norwest brought a new philosophy, led by a sales-obsessed management team that viewed banking not as a service, but as a retail store. The goal wasn't just to hold your money anymore, it was to sell you products. They coined a slogan, 8 is great. The idea was that every customer should have 8 different accounts: checking, savings, credit cards, mortgages, loans. It sounded good to Wall Street, but inside the branches, it became a nightmare. The targets weren't just ambitious, they were mathematically impossible. Branch managers were told to hit quotas that defied reality. If you didn't hit your numbers, you didn't just lose your bonus, you lost your job. Employees were faced with a terrible choice. You could be honest and get fired, or you could cheat and be celebrated. Thousands of them looked at the impossible numbers, looked at their paychecks, and made a decision that would rot the company from the inside out. It started small. A few bankers opening a checking account here, a credit card there, without the customer knowing. They'd transfer a few bucks from a real account to fund a fake one, just to hit the daily quota. But like a virus, the tactic spread. From San Diego to New Jersey, the pressure cooker culture turned bankers into fraudsters. Whistleblowers like Claudia Ponce de Leon tried to call the ethics hotline, only to be fired for their trouble. But you can't hide 2 million fake accounts forever. In 2013, the Los Angeles Times broke the story. The dam burst. Regulators uncovered that between 2011 and 2015, Wells Fargo employees had opened over 5 million unauthorized deposit accounts and 500,000 credit cards. The fallout was nuclear. The bank was fined $185 million. CEO John Stumpf was hauled before Congress, publicly shamed, and forced to resign. But the real blow came in 2018. In an unprecedented move, the Federal Reserve, led by Janet Yellen, slapped an asset cap on the bank. They were forbidden from growing past $1.95 trillion in assets. It was effectively a corporate straitjacket, freezing the bank in time while its competitors raced ahead. This wasn't just a compliance failure, it was a failure of incentives. When you prioritize short-term metrics over long-term trust, you don't get performance. You get the illusion of performance. Wells Fargo's leadership had insulated themselves from the reality of their own demands. They created a system where the only way to succeed was to lie. It took a complete purge to fix it. Enter Charlie Schaaf in 2019, an outsider with a mandate to clean house. He didn't offer flashy new products, he offered pain. He fired nearly 55,000 people. He spent billions on risk management. He turned the bank into a boring, compliant machine. It took 7 years of penance. But in June 2025, the Federal Reserve finally lifted the asset cap. The bank immediately surged past $2 trillion in assets, proving that the machinery of the business was still intact, even if its soul had to be transplanted. The story of Wells Fargo is the ultimate cautionary tale of American business. It proves that a reputation built over 160 years can be destroyed in 5 years of bad leadership. It shows us that when a company stops serving its customers and starts feeding on them, the collapse is inevitable. Wells Fargo survived the gold rush bandits and the 1906 earthquake, but it almost didn't survive its own ambition. Today, the stagecoach is rolling again, but the scars of the scandal remain a permanent reminder. In the world of finance, trust is the only currency that really matters.